if I'm right that we have slow growth and deflation, commodities are simply going to be a weak area. Now, of course, right now there's been a rush for commodities. Part of it is the weak dollar. Part of it is the expectation that China is going to grow forever. I think China's a stop-go economy. They're trying to slow down that economy. I think they'll probably have a hard landing. But commodities, I think, in the longer run are not going to be attractive if we are in a surplus world, slow growth world. I think there is another recession out there within the next year or two. Now, whether that would be called a double dip or simply another recession, that's sort of a judgment call. The point is, though, that I think now we are on the downside of the long cycle, if you will. There was a tremendous leveraging up, very high growth in the 80s and 90s. That, to me, ended in 2000. We've been on the downside. Now, we had the tremendous Fed ease and fiscal ease and the big housing bubble that kind of clouded that over. It masked what was going on. But I think we're on the downside. Now, if we're on the downside, we are probably going to see shorter expansions, deeper recessions than we had on the upside. And by the way, that will naturally carry over to other markets like stocks, which tend to mimic the economic cycle. In other words, you would tend to have more frequent bear markets, deeper, weaker bull markets, shorter in duration. The salad days of the 80s and 90s, when consumers were on a wild borrowing and spending binge, when money was freely available, those days I don't think are going to be around for many, many decades. And as a result, stock market, I think, is anticipating that that's where we're going to be. And I doubt that the economic growth is going to provide the kind of profits that are already anticipated in stock. I think now we've really got a combination of the two. We got some of the good deflation of excess supply driven by this confluence of new technologies, and we also have the bad deflation of deficient demand. Don't fight the Fed, but that's only if the Fed has the ability to operate monetary policy in a conventional sense.
Emerging markets, another area you counsel investors to sidestep.
You got to be very careful there because these economies are still dependent on exports. And those exports, directly or indirectly, most of them went to the U.S. consumer. The U.S. consumer now is retrenching. What they're struggling with is, in my view, is figuring out how to replace the U.S. consumer as a buyer of exports. Because when everybody wants to export and nobody wants to import, that's a recipe for protectionism. That's how that problem gets solved. I'm really agnostic on gold. There are just too many. There are too many forces that can push gold around. You know what's happening to the gold bugs, the central banks, the supply demand, the Indians. You know, when they're rich they buy gold, when they're poor they buy silver. You got a lot of things. I can't quite figure them all out. So I'm agnostic on gold.